You don't want the founder like strapped to make his mortgage payment. Like he's going to make bad decisions.
The quicker I can find someone better than me and get out of their way, then I'm doing my job well. I want it to be my table, but I want to be the dumbest guy there.
Amen to that. Welcome to Money Mavericks, the podcast where we explore the dynamic world of finance, investment, and entrepreneurship.
I'm Kirk Drake.
And I'm Daryl Hicks. Together, we're here to bring you the latest insights, expert opinions from the trailblazers who are redefining success in the financial world. You've had a lot of experience both on raising capital and on deploying capital, right? We talked a little bit about the deploying of capital, and you started out kind of shooting from the hip with the corporate VC and just any kind of deal that looked good. And now you've said, okay, after a couple of things that kind of blew up and didn't work, fortunately, more wins than losses, like you said, but a lot more rigor to it now. But I know you've also got a lot of experience on the raising side. I'd love to kind of just for you to unpack that a little bit, because obviously fintech executives, if they've got a really good idea, you talked about cash flow, super, super valuable point, right? Cash flow can overcome inefficiencies in the wings of the airplane and kind of just power it through, take a good enough idea and push it over the hump to make it successful. And so, maybe a little bit of some of the wisdom that you've got or the experience that you've had around the raising capital side would be great.
Having good relationships, and I guess this is sort of part of the trend as well, like, when you've made money for people in the past or made money with people in the past, there's that level of trust, right? We are good communicators. We don't bury our heads in the sand if things aren't going well. We deal with it head on and we say, hey, sales are slower than we need and we want your help. We don't hide any of those facts. And I think that's been good for our reputation. And when I say our reputation, traditionally we're coming in and there are other funds coming with me, right? So it's my cash that goes in, but we don't have LPs anymore. I had that in 4 funds where I was the GP and I had LPs. I'm lucky to be at a point now where I live and die by my own decisions. It's my capital at risk and my capital when it wins. So that's a bit of a different dynamic. But I guess I would say that we've had success in raising because we have an expertise and we are going to slow down and articulate it or explain it when people have questions. Too often when people are raising, it's like, well, you got to just get this and you saw it in our spreadsheet and look at the growth that's going this way. So you either get it or you don't. When people come at it from that side in an industry I don't get, it makes me close my wallet up pretty quick.
I was talking to an investment banker the other day who's done a bunch of IPOs over the course of his career. And I asked him a question about what makes a good public CEO. What do you look for when you see a founder entrepreneur and you say, this guy is going to be a great public CEO? I didn't get the answer that I expected, but I just want to build on what you just shared there, because where he came out is he said, beyond the obvious industry expertise, it's like, are they authentic? Are they sincere? Are they high integrity? Let themselves not be manipulated by the capital markets or other so-called experts and stay true to themselves and their values. And I hear a lot of that in the communication with your investors.
Yeah. So the public markets are a totally different beast, right? And usually when we've had exposure in the public markets, we have taken something we built public, right? We've done that 4 times. We have a pharmaceutical drug development company which extracts and isolates pharmaceutical compounds. It's one of the leaders in the world, called Filament Health. One of the conversations we had very early in that deal is going public is a totally different beast. You now have 2 very distinct jobs, right? You have to run the company, execute on your business plan, manage your cash, do all of the things you would have to do if you were the CEO of the company. You have to do those things. And then you also have another full-time job, which is managing the story, the public perception, your investor sentiment. And if you fail on either of those, you fail, right? If you fail on both, you fail. So it really is that balancing act. So in the public market CEO world, you do need somebody with a little charisma, somebody who's going to not be afraid to travel and do the road shows. It's a huge distraction to be a public company, and it's a huge expense. There's big opportunities to it. but there's monster costs in time and cash.
Would you ever do it?
I'd be a horrible one. I'm not the metronome of consistency in our businesses. If we've got a problem to solve, drop me in for a sprint. There's probably no one better to solve it. And then I get out of the way.
Yeah, like a maverick. Yeah.
Yeah.
No, and it's true. One of the things that's really come through in this conversation too is know thyself, which is one of the
Yeah.
hardest things out there, right? And give yourself permission to be yourself once you know yourself as well. Try at staying in your lane and your zone of expertise, your zone of genius, so to speak, right?
Yeah.
I think is important. You know, the CEOs of a CEO of a publicly traded company needs a little bit of charisma. I would say that's important for any CEO of any business, because relationships at the end of the day, high integrity, transparency, all those things that you were talking about, charisma kind of falls into that bucket as well in managing those relationships, I
Yeah.
would say.
I guess I should put the caveat on there. If you ever see my name as a public CEO in one of our companies, it will certainly have the word intern in front of it. You know, if you drop me in and I'm needed for a period of time, I'm basically riding the ship, going through a growth spurt, or like I'm looking for the full-time guy to replace me. The quicker I can find someone better than me and get out of their way, then I'm doing my job well.
Yeah, you're
Right?
you're Mr. Wolf from Pulp Fiction, right? The cleaner. I'll be
Yeah.
there.
Yeah.
It's a 29-minute drive. I'll be there in 27 minutes.
Well, like what I like to say is I want to be the dumbest guy at the table. I just want to own the table or a piece of it. I want it to be my table, but I want to be the dumbest guy there.
Amen to that.
On Money Mavericks, we don't just talk about making money. We explore the innovative strategies and bold decisions that drive real change. Whether you're an experienced investor, a budding entrepreneur, or just someone looking to make smarter financial choices, we've got something for you.
Every week, we're going to sit down with industry leaders, visionaries, and mavericks who share their journeys, challenges, and breakthroughs, from contrarian views on market trends to the secrets behind building a successful startup. You get an inside look at what it takes to thrive in today's economy.
And we promise to keep it real, engaging, and most importantly, actionable. No jargon, no fluff. Just straightforward conversations that you can apply to your own financial journey.
So get ready to challenge your thinking, expand your knowledge, and take control of your financial future. This is Money Mavericks,
where we turn financial dreams into realities and mavericks into legends.
One of the major milestones that very few entrepreneurs ever get to is someone walking up to you and saying, hey, this thing that you built from scratch with just a few people around you, I think it's really cool and really valuable, and I'd like to give you some money for it. I also find it interesting what you did with that money. How did that affect you when you first closed that transaction? And then why the decision to go and take that into and invest it into the next business, or kind of like what exactly was the self-talk and what was happening during that?
I think we always knew that a diagramming tool would never get above $1 million of recurring revenue. I didn't see it, so from early on, we sort of knew that we wanted to do something larger, and we had an idea that what we wanted to build was a loss control product, but we really wanted to also put some distance in between us and my old employer. Even though there was no agreement, there was no IP issues or anything like that, it was a respect thing. But we always had in the back of our head, like, we should build a loss control platform because there's none out there. There was zero at the time, really. And we kept getting approached by people, can you build me a system? And eventually, between that money and us saying, yeah, I'll build you a system, I'm keeping the IP, give me $300,000. That's how we bootstrap stuff, man. It was like basically charging people, keeping the IP, they get a copy of it, they can go do whatever they want for their services business, and we can restrict them. But we were going to be a software company that took recurring revenue, and to bootstrap it though, you had to get that quick hit cash. It had to be upfront services type crack money. I mean, that's what services is. It's like, I do an hour, I get paid $200. Like, I can make payroll, right? Like, whereas recurring revenue, a lot of times you're putting millions and millions of dollars into a product in order to get, a small chunk of that each year out of these clients. So, and I think it was just necessity to, like, I mean, at some point, like at the time, we didn't want to raise capital. I didn't know anything about raising capital. I was like, no, you build a business by like building your business. And when you have cash, you build stuff. And like, that's the way I was raised. So I didn't know anything about the world of like some VC is going to give you $1 million and you can go burn it in a barrel. I didn't even know that concept back.
One of my mentors said to me, the minute you raise institutional capital, you have to treat that money like a very high interest rate credit card. And I think some of that rigor comes from your experience before, where to fund the business, you were taking out essentially like a second mortgage on your house with a guarantee on you and stuff like that. There's not a lot of people that have that ability to take that level and bet on themselves in that way. But I think you start to build the muscle memory around like capital is scarce. We have like operational efficiency is critically important. And, what do you do when things don't go to plan? How can you look that abyss in the eye and still manage to find a way to come through it? But yet, I know that part of your story, it was a long journey that was massively accelerated with capital. And so that's the piece that I'd like to unpack. You find the right investor, you've gone through this filter, they've built a relationship, you raise the right amount of capital. There's another theme in there, but talk to me about like what happened when you raised that capital. What was the impact that it had on you and on your business?
Yeah. So a couple things, 2 types of capital. There's primary and secondary capital for the people listening to this. Primary capital is what goes on the balance sheet of the company for spending, and secondary capital is what goes to the founders for some liquidity. Typically, when you're running these companies, you don't want the founder like strapped to make his mortgage payment. Like he's going to make bad decisions. So typically they'll give you a couple $1 million to clean up your life, so that you can go run this company for them and not feel levered by cash. But at the same token, they also don't really love giving people a lot of cash, because then they're worried you're going to take off on them and go to Europe. So anyway, what happened with that is that, we took on that capital, and the thesis was that we could take this revenue that was split up the wrong way. And, if I'm just being honest, we had support that was services, but it was recurring. We had maintenance, we had software license, we had hosting, and all those weren't considered the highest level of quality of, essentially revenue. It wasn't all pure SaaS revenue. So we knew that we had to bundle all that together and resell that basically to all of our client base. And we knew that we were going to have to go down in revenue for 2 to 3 years to resell the clients on a new package that was smaller than their original package in terms of dollar spend, but basically included everything and kept the gross margin above 70%. That was the whole play. And so we knew we had to go through this curve, this downward curve, where we're going to lose revenue for a couple of years while we're ramping up go-to-market and sales, while we're renegotiating all of our contracts, while we're professionalizing the company. I hate to use that term, but like bringing in a board and bringing in a chief marketing and bringing in a chief revenue and bringing in a CFO and all the things that as a bootstrapped entrepreneur, I didn't want to spend the money on. I had a controller. I didn't have a CFO, like I had a head of sales. I didn't have a CRO, I didn't have that level of person in the company. So I think the reason why we were able to accelerate so fast, which was, I don't know, what was it, 34 months from investment to exit, was that we knew that we had that thesis for revenue conversion, first of all. We knew we didn't really have real go-to-market or marketing previously, and we were still growing at like 100%. And so I think we were able to take those things and combine them and bring in a really great team and spend a lot of money, a very millions and millions of dollars to make that happen. And then, timing was everything. I tell people now, because they're like, 2021, you hit the number you hit it perfect, like highest valuations ever. True. It's entirely true. But I tell people today, like, you have to always be ready to sell if you can. Like you should already be fighting weight. You should not have to be like, I think we're going to sell in 2028. Like, okay, you don't know that. Like you can guess that. That can be like what you want, but like you should be like constantly thinking like, I need to be rule of 40 every year plus. I need to be thin. I need to like not have excess expense or anything like that. And I need to have my shit together to go to a banker at any time. Like this can't be, so that's how I think about it. So we use that capital for basically hiring CFO, CRO, CMO, for putting the board in place, and then going through our revenue change was a part of that. That's how we sort of skin it.
Thanks for tuning into this episode of Money Mavericks. We hope you found it insightful and inspiring.
Don't forget to subscribe, like, and leave a review on your favorite podcast platform. And be sure to share this episode with someone who needs to hear it.
Stay connected with us on social media and visit our website for exclusive resources, episode transcripts, and more.
Until next time, keep pushing the boundaries, making smart moves, and turning your financial dreams into realities.
You've been listening to Money Mavericks, where Mavericks become legends.